All right, welcome back everybody. This week we're going to talk about underwriting deals. So after you have identified your market, you work with your broker, and you find this deal that actually looks good, how do we decide that this is a great deal and something you want to proceed on? So we really need to look at things like the rental income, the vacancy rates, expenses, and financing. Those are some of the starting points for evaluating a deal. So the first thing is obviously the rental income. How much income does this property produce? So there are really three ways to look at that. The first one is the broker's pro forma, which we're going to be very careful about because they're going to use the most optimistic numbers, and typically they're very dangerous to use. Instead, we can look at current rents. What is the current owner actually taking in? And we can look at something that's called, the T12, the last 12 months of income. We can also look at market rents because quite often the current owner are below market. So we can evaluate what other properties in the market are getting in terms of rent and see if there's an upside. Is there a way to increase rent and therefore increase our income? There's also other ways to earn income on a property. We can do pet rent, for example. If they have a cat or a dog, we can charge $25 maybe a month. Is there laundry on site? That could also produce some income for us. Assigned parking, maybe in a nicer apartment building. Maybe there's some units that have covered parking, and we can charge the tenants to park there. And if the property is not individually metered, we can charge back utilities, which will help offset some of our expenses. After we know what our income is, we need to look at expenses. And again, it'd be useful to get the T12, the last 12 months of expenses from the seller. Depending on if they're self-managed or have a management company, those expenses can be accurate or not so accurate. So, take it with a grain of salt and evaluate and normalize those expenses yourself. So the major expenses we have to deal with are vacancy, typically in the 5 to 10% range, depending on the market. Property taxes, that really depends on the county. It could go up if the property is sold because it'll be reassessed, so don't be surprised about that. Insurance, that really depends on the property. You need to have liability and property insurance. Repairs and maintenance, that's the annual cost you have to pay for fixing various plumbing issues, painting, things that just goes wrong in the units. And typically kind of expect to pay $500 to $800 a year per unit on a B or C class property. It can vary from nicer property may have lower expenses and older properties more, but $500 to $800 kind of industry standards here. Utilities, that really depends on who pays utilities. In some markets, individual units are metered for gas and electric, and the tenants pay that, and maybe the property owner pay water and sewer. In other properties, everything is on the owner or everything is on a tenant. So make sure you understand that and figure out what the expenses are for utilities. Contract services, that's things like you have a pool maintenance, snow removal, yard or landscaping, pest control. Typically goes from $250 to $450 a year per unit per year, depending on how many services you need. Payroll, if you have a very large property and you need on-site management, maintenance staff, lease-up staff, you can expect $1,000 to $1,500 per unit per year for your payroll expense. Management fee, again, that really varies a lot depending on if you don't have on-site management as an off-site management company, expect to pay anywhere from 8 to 10%. If you have on-site management, on-site staff, you can get away with a lower fee because the management company don't have to pay payroll. That's a separate line item. And then what we call CapEx expenses. Those are things we kind of save up for large costs, such as new roof, new windows, new parking lot, and all that stuff. So that's a large expense that we need to save for over time, and typically $250 to $300 a year we need to put aside for a CapEx. But a quick rule of thumb is that your expenses are typically 45 to 50% of your gross potential income. Another thing you need to look at when evaluating property is deferred maintenance. has the current owner kept up with the repairs, exterior repairs, landscaping, interior repairs? Are the units tired? Have they been upgraded? You know, is plumbing and electric up to code? What about landscaping? So look at all those things, because that could very quickly become expensive. I've seen units that need, you know, $6,000, $8,000, or $10,000 per door to get them up to modern standards, and others were just, you know, a couple $1,000s can do the work. So be very careful and understand exactly what your deferred maintenance costs are going to be. So after we've collected all the income and expense numbers, we can start underwriting the deals and calculate our net income, NOI, and cash on cash returns. If you don't remember what those numbers are, go back to one of my prior webinars where I explained those in detail. So here's an example of a 16-unit apartment building and the underwriting on that. Our property price is $850,000. We have some down payments, CapEx, upfront CapEx, and closing cost. So we need to come up with $266,750 to close this deal. Our rents are $600 a month for a total of $115,200, and we have some vacancy of 5%, which leaves us with a gross income of $109,440. So that's our income. Let's look at our expenses. We have a $5,000 insurance expense, property tax of $8,000, gas and electric of $2,000. Those are just common area expenses. The tenants pay their own electric bill. We have water, sewer, of trash of $12,000 in this property that the owner pays that. Our repairs and maintenance budget is $800 per unit per year for a total of $12,800. Contract services such as pest control, landscaping, and so forth is $3,200. Management fee is 7% at $5,472. So our total expenses are $48,472, leaving us with an NOI, a net operating income of almost $61,000. That's an expense ratio of 42, which is, it's a good expense ratio, maybe a little bit on the low side, so make sure these numbers all make sense. So now we need to calculate our cash on cash and cap rate. So we need to take a couple other things out of that. And there's some debate how you want to calculate this. If you want to look at really what is the number that's put into your pocket every year, I like to maybe subtract the CapEx to arrive at a true number. So we end up with $5,600 of CapEx reserves that we pull out, and we had a debt service of $36,000. You can go and calculate what is it going to cost to borrow 75% of $850, and that was about $36,000. So we end up with a net cash flow of $19,368. That's the money in your pocket every year. So what is that in terms of cash on cash? Well, that's 7.3%, and that's basically the net cash flow divided into your total cash outlay. So then gives you your cash on cash return. And your cap rate is your NOI divided by your property price, and that's a 7.2. So are these numbers good or bad? Well, that's really up to you to decide. Can you go and earn 7.3% of your money somewhere else? Maybe. Is it enough for are you getting a high enough return on the risk you're taking? So that's really up to you, but it gives you a way to compare this property to another property and see how they compare. Okay, so should you proceed? Again, as I mentioned before, it really is up to you. Does this property meet your criteria? And you may need to underwrite a lot of deals to find one that makes sense. Just be conservative, stick to your criteria, and move on if a deal doesn't make sense. And get really good at underwriting, because it could be, you know, tens of deals you need to look at before you find one that makes sense. Again, if you want to hook up with me, talk about real estate or anything else, go to my website, opendoorscapital.com/call, and we'll schedule a call. Thank you. I hope you have enjoyed this. If you need a spreadsheet or more help calculating stuff, reach out to me. I'll be happy to provide some additional information. You can send me an email at jens@opendoorscapital.com. And next week, we're going to talk about writing offers.